Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
So here's the latest this morning. The US amassing its largest military buildup in decades around Iran, with current and former officials saying the Trump administration appears ready for strikes on military and strategic targets. Joining us to discuss is Stephen Cook, the Senior Middle East Fellow at CFR. Stephen, welcome back to the program. I asked Jonathan, our colleague, what does success look like? Struggled to answer. I think most people do. But there's an additional question we've all got to ask as well. What is success, and are the risks of pursuing it worth it? What's the answer to that, Stephen?
Well, first, on the question of success, the success is anything that President Trump defines it as. And I think that that's the issue here, and that's what I think people are struggling with. He operates in a totally different foreign policy level than most of us who've grown up around the U.S. foreign policy establishment, which is he could very well order the strikes, and however they come out, he'll declare it a success, whether it's regime change or attacking the Iran nuclear program. Now, you asked a very important question about the risks. The risks are, of course, one that it does not work and that the regime remains in place, retaliates against American partners in the region, fires on American forces in the region, and we're often running into a broader regional war. That is, I think, the worst case scenario for the United States. The Iranians are greatly weakened, but the Iranians still have the ability to cause a lot of trouble around the region. So if the United States goes, it's going to have to be sure that it's going to be able to affect the kinds of changes it's seeking. The question is, what are those changes? Is it removing the nuclear program, which, by the way, last June, the president said was totally obliterated? Is it regime change? Is it going after the ballistic missile program, as the Israelis have been advising? We won't know if and when he orders those strikes.
Stephen, if there is a strike, what do you expect the Iranians to do immediately in terms of retaliation?
Yeah, they have been full of bravado in the last week. They conducted an exercise for several hours in the Strait of Hormuz, a very strategic waterway that connects the Persian Gulf and the Indian Ocean. They have threatened to rain missiles down on Tel Aviv. I think that is probably the most likely response from the Iranians, which is why the president has ordered the USS Gerald R. Ford and its carrier battle group into the region. That group of ships, along with the USS Lincoln, provide and augment air defense systems for Israel's already robust air defense systems and provides air cover for America's partners in the Gulf. But the Iranians are limited in terms of their ability to take on the United States. So that's why it seems likely they'll use what remains of their ballistic missile force to try to do a lot of damage to Israel and perhaps other partners in the region.
When the USS Gerald R. Ford arrives this weekend, it's going to be a massive military buildup. Do you think that buildup is enough for the Iranians to come to the table in earnest on the three top issues this administration has outlined: ballistic missiles, nuclear, as well as money to proxies?
Well, that would probably be the best possible outcome for the Iranians. But so far, at least publicly, they are digging in. They are saying that they will retain their right to enrich. They're willing to negotiate enrichment around the margins. They've come up with some ideas about a pause, which really doesn't matter, shipping enriched uranium out of the country. But I think the theory is amass a lot of force. If the Iranians don't capitulate, then you really do have to use that force, because otherwise your credibility is blown unless you use it. And the president has been clear. They either come to terms within the next 10 or 15 days, or he's going to use that force.
What do you think the outreach has been between the administration and allies in the region, Saudi Arabia, UAE, and Israel as well? On the oil front, do you think the OPEC members, if Iran starts to strike some tankers or close the Strait of Hormuz, are they willing to get some more exports on the market to keep prices down?
certainly think that the Saudis and the Emiratis, who have said that they will not participate in American strikes on Iran, will definitely play ball on the oil front. First, I think there's a lot of American force in the region, so whatever disruptions there might be to the oil market, it'll be temporary. But of course, the Iranians have been putting oil on the market despite being under heavy sanction. But I do think we are at a moment where the Saudis and the Emiratis, despite Saudi financial and fiscal troubles, would play ball if it does mean a positive change to Iran.
How close is coordination right now between Israel and the United States? Because as you said, if there's going to be a retaliation, it's going to be across the Israeli skies.
Yeah, there is a very significant amount of coordination. There has always been a significant amount of coordination. And at these moments, the United States and Israel are working hand in hand. The Israelis have said that this is going to be an American operation, and they are going to be the wingman for the operation. There's also close coordination with other members of CENTCOM. If you look at where the United States is moving assets, it is throughout the region. So countries, although they are somewhat reluctant to publicly say that they support or will participate in this operation should it come to pass, are nevertheless keeping up with their responsibilities to CENTCOM and opening access to their bases and allowing the United States to operate from those bases.
Stay with us. More Bloomberg surveillance coming up after this. Let's move on. Let's turn to Netflix. The company's co-CEO, Ted Sarandos, countering a key complaint in the high-stakes battle for Warner Brothers.
We're going to keep Warner Brothers running pretty much like they are today. And in fact, it's even quite better for theaters because now that we're going to be in that business and own a theatrical distribution entity, we're going to take some of the Netflix films and put them through that as well. So it's very likely that you'll have even more outcome of high-quality films for the theaters if this deal goes through.
His comments coming as the Justice Department assesses the deal's impact on theatres. Alicia Reese of Wedbush Securities writing, "We believe that Netflix can create jobs, boost production, and offer consumers more value at a reasonable price. The Netflix deal is superior to Paramount Skydance." Alicia joins us now for more. Alicia, welcome. This drags on. Is it becoming a distraction for the stock?
It is a distraction for the stock, absolutely. The issue is that Netflix is perfectly well balanced as a company without the acquisition. It has significant growth opportunities, particularly in advertising. Now, this certainly would help if they got the deal through for long-term growth, especially if they're able to, leverage their new advertising vehicle throughout Warner Brothers as well and drive that global growth. But they don't need it, and it's certainly been a distraction and has weighed heavily on the stock. But ultimately, we do think, Netflix will be okay without this deal. And the regulatory headwinds are, significant.
Well, Alicia, let's talk about why you believe they'll be okay. And you alluded to it. Do you think we're underpricing how they're positioned to take advantage of a big rebound in global ad growth?
Oh, absolutely. Yeah. And I think without the deal, the shares would have been okay. They did have a bit of a hiccup a couple quarters ago with their reporting, just because, the expectations are enormously high, for the stock because they've been, so healthy for so long. But the ad opportunity is growing. They're adding more capabilities throughout the ad stack. And the ability to do targeting on a global scale is significant with all of the users. And so I think a lot of that performative marketing capabilities that they have or will have and are building are wildly underappreciated at this point.
Because everyone else is looking elsewhere. So let's talk about the elsewhere. One feature, Alicia, as you know, of the hold-up in closing this deal, one aspect of all the complications, theatrical releases. Have they got a PR problem? And what are they doing to counter that now?
Well, going on Bloomberg yesterday and on Matt Bellany's The Town podcast, Ted Sarandos, I think, dispelled some of the concerns around that. You saw, Sean Gamble, the CEO of Cinemark, the other day on his earnings call, noted that, the 45-day window that was promised, it wasn't clear. Is that going to streaming right afterwards, or is that going to go to the TVOD window where you can buy or rent? The actual windowing matters a lot to Hollywood. And so Ted Sarandos did clarify that yesterday, that he does intend to take the titles to TVOD before the streaming window. And that helps a lot. They have an opportunity, Netflix does, to show Hollywood the real intent. They have Narnia coming out later this year. They have it set for an exclusive IMAX release and then going to streaming directly. If they change that to, an IMAX exclusive release and then created a wide release for that with a TVOD window, perhaps, that would give Hollywood a lot more backing for this deal. And that would create a lot less friction.
Do you think they need to do that to really show Hollywood that they're committed to theaters?
I think there's still a lot of skepticism. Even with those promises, the skepticism is that they'll do that at first for the first few years, and then they'll shift back to their old ways. And so doing that with Narnia, where they don't have to, I think that would create a lot of goodwill.
I think it's obvious why people think that. Remember, Netflix was the blockbuster killer. You used to get the DVDs in the mail, and what's the point then of why you would want to go to a theater? You say in your note, the bottom line is that Paramount Sky needs this deal while Netflix does not. Why does Paramount need this deal?
Well, Paramount needs it because they're struggling to, get to profitability, and they need more, theatrical, and they'll have to cut costs, though. They're cutting costs pretty significantly right now with the current integration. And so, looking for growth in this market, especially if they have the linear TV deal, and especially if they bring on the Warner Brothers linear as well, there's just a lot that needs to be cut, and there's not a lot of natural growth in that market particularly. So Paramount will have to build on its theatrical releases and build in other areas of the business, and that's not necessarily easy to do organically in this market.
Alicia, just to wrap things up, could I get your thoughts on the other threat to the studio business and the trajectory for the price of content, given the amount of AI initiatives we've seen develop more recently? And we've all seen these examples come out on social media of people just making their own movies. I have to say, it started out not so good, and now at the moment, from what I've seen over the past few weeks, things have moved on pretty quickly. What are your thoughts on the trajectory of things?
They are moving on pretty quickly, but you're seeing the studios come out vehemently against this, and putting out some cease and desist orders. This isn't going to fly because the issue is that those models were learning based off content that they shouldn't have had access to, and they certainly didn't pay for. If there were deals in place that they had paid for to teach those models, sure. But a lot of the AI models were based on content that, they shouldn't have had access to, and they certainly didn't legally. And so there are a lot of ways for the studios to protect themselves against this, and hopefully that's swift enough to be meaningful.
Over time, though, for the studios, do you see it reducing the price of content?
Sure. I mean, just as, user-generated content has become more and more popular, it creates an alternative, certainly to more expensive content. But, really it comes down to what's the most compelling. And so I think, these kind of combinations, like you see, Netflix wanting to do with Warner Brothers, is more meaningful because, there are a lot of content alternatives out there. But if studios are able to leverage that to get better content to screens faster, that can certainly, thwart some of those AI efforts.
Stay with us. More Bloomberg surveillance coming up after this. Stocks adding to losses after snapping a 3-day winning streak. Jitania Kandhari of Morgan Stanley Investment Management writing, we see a shift from concentrated sources of growth and returns to a greater dispersion and wider set of opportunities, both within the US and across global markets. Jitania joins us now for more. Jitania, good morning. How are you considering developments in the Middle East and the risk aversion we're starting to see and the move in crude off the back of threats of military strikes in Iran?
Yes, I do think that the probability of that is clearly rising. I do also believe that the Middle East is now one of the middle powers, as you can see, that region between the Western and the Eastern Hemisphere, which is getting dominated by US on the West and China on the East. And that region is becoming very critical from a logistics standpoint, from a trade capital standpoint. So I do think that the higher likelihood of tensions in that is going to cause some market volatility.
Geopolitics is traditionally very, very hard to predict, so I'm not going to put you on the spot and ask for a prediction. I'd like to go through a range of scenarios, one in particular. If we do get another spike higher in crude, and year to date, we've already seen a move of almost 20% on crude, whether that would upend some of the cyclical trades that a lot of people have gained some enthusiasm for coming into 26.
I think the most important manifestation of an increase in oil prices will be on the CPI. And I think that the inflation outlook, which has been relatively okay, even the expectations of core PCE in our models is about 2.7%. If assuming crude prices at these levels, so I think that can really be detrimental to the inflation situation, which then leads to the rate story and therefore, of course, some of the cyclical trades unwinding. And so that's something to keep in mind. But I do not think our base case view here is there is still supply, there is still OPEC capacity to supply oil. So there could be an interim move, but I think overall the demand supply situation is not justifying a spike in prices once the dust settles.
Could it, though, galvanize the hawks on the Fed to potentially want to continue their wait and see mode or even hike?
Yeah, I mean, I think that, the interest rate expectations in terms of 2 cuts are the maximum we can get. And based on the current CPI and the PCE at 2.7%, as I mentioned, I think that at these levels, one can expect maybe a cut or maybe none. So that will definitely be an issue for Fed cuts.
When do you have your first cut priced in?
Next year.
Next year. So this whole year will be wait and see mode when it comes to Federal Reserve. Is that even possible to Kevin Warsh at the Fed?
Well, I think it's going to be a function, as I said, of inflation, but also employment. And that clearly there has been some stabilization, but we're not out of the woods there. So there will be an equal emphasis there. So I think we could definitely see a cut. But the fact that QT is over and the Fed is expanding their balance sheet, that may be under question under Warsh because he has not been really a proponent of that.
Let's stay on equities. On the equity side in the US, the rally stalled at the index level, and we can see that, the S&P within around 2% of all-time highs. It's taken off elsewhere, Japan, South Korea. South Korea's had a massive move year to date. And EM equities, looking at the EM equity story for year to date, double-digit gains so far. What's happening there? What am I buying? What's the story at the moment? What's the bet?
I think you're buying uncorrelated sources of alpha outside the AI trade and the maximum juice on the AI trade, which is the AI enabler. So in Asia, it's a lot about the semiconductors, the networking equipment exports, the capex that's coming with those exports, and the net worth effect that's happening with the buoyancy in exports. In pockets of Latin America, you have a commodity tailwind because a lot of these countries are actually in the critical mineral supply chain and copper and uranium and all that we need to power this AI story. And then in Eastern Europe, you have spillovers from pockets of Europe and the stimulus there. So the core versus the periphery versus Eastern Europe. I think the smaller cap countries look interesting, which are in the emerging space. So different sources of drivers across different regions, which is powering this. And lastly, the monetary and fiscal orthodoxy in the EM world has been much more superior than the DM world. So that is showing up in terms of central banks cutting rates, States in terms of fiscal balances being in a much better situation than the developed world, especially the US.
When you look at the backdrop, how much of it is a cyclical story versus secular? Is it a mix of both?
It's a mix of both. I'd say one interesting theme that is developing in North Asia specifically, which seems to have structural legs, is US will not be able to really onshore everything, right? Whether it's shipping, some electronics, biotech, automation, robots, and that supply chain, the autonomy supply chain. They won't buy from China, but they'll buy from North Asia, which have export similarity like China, and where those vendors will be US preferred in terms of supply of all these things. So I think that's another area outside semis and tech that is seeing momentum in terms of the markets.
So you want to be exposed to those, what potentially are these partners with the United States when it comes to national security and core features of the AI trade?
Right, and even like shipping, in autonomy. Look at the robot density in China compared to the US. So the second derivative plays of sensors and LiDARs and everything that is in the supply chain of autonomy, which is coming on the factory floor in the low altitude economy in space. So yes, I think Korea, Japan are some interesting markets there to source a lot of this, because China is going to not be the preferred vendor.
Do you think the midterms will be a catalyst to potentially pour money back into the United States because there'll be looser fiscal policy?
The interesting thing is that, there has been de-Americanization on the trade side, where regional trade blocks and trade deals are being made. On the capital side, interestingly, we are still seeing a lot of FDI come into the US. So I think that is because part of the trade negotiation has been bring capital back. I was at a healthcare conference. A lot of the companies said we're bringing manufacturing back. So I think that's seems to happen and will continue. But I think the big thing on the midterm is, what does the Democratic win of the House mean? We've seen a lot of Trump trades in the market. Does that come under question? Gold is a Trump trade, regional banks and deregulation. So I think one has to be really discerning, because that could have some sentiment impact tactically in the market.
You think the financial story is vulnerable?
I don't think the financial story is vulnerable, because I do believe that the consumer and the private sector from the banking side is delevered in the US. There's no excesses. The excesses are residing more else, in private, probably. But I don't think it's vulnerable, but I think there has been a decent momentum trade there, and one has to be just discerning.
Can we finish on that on private markets? So I'm not going to talk about the story too directly, because I imagine you can't talk to it directly either. I'll talk about it in general terms. When you start to see redemptions and certain funds struggle to meet redemptions, people start to have concerns about what's developing. And the story this morning, of course, is Blue Owl, and the stock is down again by 3.7%. Do you see risks of contagion, broader systemic risk emerging here? Or is leverage so much lower this time compared to, say, 07, 08, that you can have pockets of instances like this that don't necessarily mean we've got bigger problems around the corner?
Yeah, I don't think there has been an excessive and a systemic crisis in the making here. Of course, that market's grown because the banks have retreated due to all the regulatory issues. Some of that will, with the deregulation, the banks will come back into that space. So the returns you made in private credit in the last few years, maybe you cannot make those same amount of returns. But there have been very strong players in this space, and I don't think this will lead to a systemic crisis, but definitely there is more competition in that space coming from the traditional banks.
Given how much, though, this economy increasingly has become dependent on being powered by private markets, do you think the economy in general could be vulnerable to a tightening of credit conditions?
I really don't believe there is a systemic crisis here, because in the history of markets, there is crisis only when there's excessive leverage, when credit grows way above GDP. Our thumb rule is when credit grows 20% more than GDP over a 5-year period, that is a red flag. I don't see that in pretty much many pockets of the world. Like you don't. There's a lot of the credit side, there's been deleveraging. So yes, there's been retrenchment on the households and the corporate side in traditional banking channels, and some of these pockets have grown, but there is not like an excess in terms of empirical numbers.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.